Hi, I'm Mike Demski back for another investment committee update. There's three things I want to talk about today. One is the persistent move higher in the price of gold. Number two is the recent move higher in interest rates, been significant over the past month or so. Also, I know a lot of folks have the election on their mind. I want to talk about how markets behave in an election year. There has been a lot of action in the bond market over the past month and a half. If you look at the right side of that chart there, that is the 10-year Treasury rate moving from 3.6% to 4.3% just in a month and a half, which is a huge move. However, 4.3% is the average that the 10-year Treasury traded at throughout 2024. Our investment committee continues to believe that longer-term interest rates should remain elevated as there are soaring interest rate costs associated with our national debt. Also, there is excessive deficit spending. However, the short end of the curve should continue to move lower as the Fed is expected to continue to cut interest rates. This is all dependent, however, on the path of growth. As interest rates continue to make larger moves day after day, bond market volatility is on the rise and is currently higher than stock market volatility. We expect this to continue given uncertainty regarding U.S. debt and growth. I find this chart really interesting. Gold is up 31% year to date. That's more than all of the major indices, the S&P 500, the Dow Jones, and the NASDAQ. Gold is typically correlated with the value of the dollar. The dollar falls, gold rises. However, given the dollar rise over the past month and a half or so, gold prices continue to move higher. That is very interesting and is telling that gold may be sniffing out something that the market is not. We're aware that there's some folks out there that are still feeling uneasy about what the impact the presidential election might have on markets. Good news is the chart here shows that historically, during election years, markets are on average positive double digits during those years. Once we exclude 2002 and 2008, which had little to do with the elections, there's actually very little difference between election years and non-election years in terms of market performance. Now, we're not saying that there won't be some sort of short-term correction in markets following the election, but just telling you that on average, markets are up double digits during election years. We've covered the three top things that are on our mind right now, which is interest rates, gold, and the elections. Thank you for watching, and if you have any questions, please call our office at 727-252-1050. Thank you.